Hello everyone. For this assignment 2, our group are going to search and analyze the key 225 stock market index derivative in Japan. Here's our content. So first of all, we need to make a quick introduce and explain our objectives about the Nikkei 225 index and why we should know and invest in these derivatives. This is an index of 225 stocks traded on the Tokyo Stock Exchange, introduced by the Japanese economic news agencies. It was first introduced in 1950 with a value set at 250. It is price weight index rather than a market capitalization index. And like Dow Jones, the index price is derived from the per share price of its consistent stocks. The index tracks the shares of the 225 largest Japanese companies listed on the Tokyo Stock Exchange and is a key indicator of the Japanese stock market, as well as a major Asian stock market benchmark with global references. So with this, we need to explain why we choose this derivative for our study because firstly, the Nikkei 225 index represents Japan's largest industrial and commercial companies and covers a wide range of industries such as technology, automotive, consumer goods, and so on. By investing in this index, investors can diversify their exposure to the Japanese market without directly purchasing individual company shares. Secondly, this index can be used as a hedge against other investment risks as well as the specular tool to take advantage of market volatility. Finally, the series of policies implemented in Japan over the past decade, known as Anbei economics, which included quantitative easing to stimulate economic growth and inflation, have had a positive impact on the stock market, and the Nikkei has risen as a result. And about the history of this index is that from 1971 to 2010 was its all-time high and then fell. Looking back at the Nikkei index since its IPO, it experienced a boom in 1970s and 1980s, reached at the 38,807 mark in 1990, but has not been able to break through this level since then due to economic weakness. So since 2010, the Nikkei has been on a steady upward trend. During this period, the Japanese government implemented a quantitative easing policy, and the stock market has been supported by the strong growth of Japan's export sector during global economic growth of the Japan's and expansion of international trade. With the current depreciation of the Japanese yuan, many Japanese industries will instead be a bargain for most investors. Therefore, this index is one of the best bets for investing in your friend in 2024. Japan's stock market has maintained a strong growth momentum over the past decade. If we look at the Nasdaq, it has been one of the largest performers over the past decade, raising more than 400%. And Nikkei has also matched the performance of the S&P 500 with a gain of about 270%. The Dow Jones is about the 200%. So when we look at its current market performance, we can see that it broke through an all-time high of 40,000 mark. The performance of the Japanese stock market may come as a surprise to some investors. Unlike the S&P 500, the Japanese stock market does not have a handful of highly valued stocks driving to its new highs. In fact, the expected PE ratio for the Japanese stock market is 15.1 compared to the 20.5 for the S&P 500, which is 32% higher than its 20-year average of 15.6. While some investors might be put off by Japan's lecture economic growth in recent decades, it is important to remember that this exposure has helped driven earn growth even in the face of weak domestic growth. So the return of the Japanese stock market to the peak of 1989 bubble has been underpinned by earnings per share that higher much would be expected from Japan's economic growth. Japan's company are now making about 3 times the corporate profits they did the last time the stock market was at this level. So in US dollar terms, earnings per share for their companies in the MSCI Japan index grew by 8.3% in 2023. This growth has been achieved despite the fact that Japan's economy is in recession, with 2 consecutive quarters of negative GDP growth in the third and fourth quarters of the last year. So next, welcome my partner to introduce the next part. Thank you.
Okay, so in this part, I will talk about the Nikkei 225 index futures. So the index futures are use a particular stock index as an underlying asset. And also, so for the trading units, it refers to the underlying value of the each futures contract. And for the Nikkei 225 index futures, the underlying value of each standard contract is a Nikkei 225, the index points multiplied with 1,000 Japanese yuan. And so, for example, if the Nikkei 225 index is currently at, let's say, if it's 338,587 points, then the national value of the standard futures contract is this point multiplied with 1,000 Japanese yuan. Then I will talk about the Nikkei 225 futures, the expiration days, and some other concept. Here we can see the table for the schedule about the trading terms and expiration schedules for the Nikkei 225 index future contracts. So it has specific experience months, which are March, June, September, and December. And then at any given time, a total of 19 contract months are available for trading. So the expiration date for each contract month is the second Friday of the expiration month, and the last trading day is a business day preceding this second Friday. And from the table, we could see all the available contract months. So these 4 traders, they can choose the contracts that best match their investment horizons, whether it's a short term or a long term. And for the risk management, they could know the exact expiration days and the trading periods, help them to plan and managing the risk associated with the future trading. And for the arbitrage and hedging, the multiple contract months allows, for example, the strategies to involve the arbitrage and hedging across the different expiration days. Then I will talk about the margin in the index futures. So to trade the Nikkei 225 index futures, a margin deposit is required. So the minimum price fluctuations is 10 Japanese yuan. This also calls for the tick size, and here is just examples. And so it's like a profit and loss per tick are 10 points multiplied with 1,000 Japanese yuan. So for examples, if the future price increased by 1 tick, traders could hold a long positions with gain 10 points multiplied with 1,000 Japanese yuan, which is 10,000 Japanese yuan. Then I will talk about the price models. So in the pricing models, the idea is follow the no arbitrage pricing, and also the spot price at time t is used to calculate the compound interest, and which is what we often call the adding the cost and subtracting the benefits. And because the cost will increase the price of our futures, and also the benefits will decrease. So however, here we don't have the holding cost. So for example, if there is let's make an example. If there is a 3 months futures contract, we know the interest rate and the yield rate and know the spot price, then we can calculate the futures price on its expiration days. Here we talk about how Nikkei 225 index futures works. So these examples roughly demonstrate step by step the mechanism of trading the Nikkei 225 index futures. So it's like the core concept is the long hedger profit from an increase in the index, and while the short hedgers will incur a loss under the same conditions. Then I will talk about the speculations using the index futures. So speculators who believe that the market as a whole will perform better in the futures, so they will buy the index futures and will gain if the index value increased beyond the contract future price. So if the speculators who believe that the market as a whole will perform poorly in the futures, so they will sell the index futures and will gain if the index value decreased. And then we'll talk about the arbitrage. So it's the core concept is like if the market value of futures is different from the theoretical values. So in this case, the arbitrage opportunities arise. For example, if the market value exceeds the theoretical values, so one should sell the futures and buy the underlying shares of the index using the risk-free borrowing. And then last but not least, I will talk about the hedging portfolios using the index futures. So when a person who owns a portfolios of a basket of index stocks, so they can sell, or we say they can short the index futures. And if the market index decreased, so the gains in the futures market will offset the loss in the portfolios.
In this part, I'm going to talk about historical events that affect Nikkei 225 futures. The first event is 2008 financial crisis. The financial crisis was triggered by the US subprime mortgage and made global stock market fall sharply. As we can see, the price of Nikkei 225 futures declined from 15,000 to 8,720 during the financial crisis. We think that there are three main factors: global economic uncertainty, market liquidity, and Japanese economic impact. The second event is 2011 Tohoku earthquake and tsunami. This natural disaster had serious consequences, influencing the Japan stock market. Based on current global and Japanese conditions, we conclude 5 main factors that will affect Nikkei 225 futures. In global aspects, there are global economic uncertainty and financial market volatility, such as the Ukraine crisis. In Japanese aspect, the economic is recovering stable but slow in pace. The Bank of Japan still maintains an ultra-loose monetary policy to support economic growth. In conclusion, we recommend that investors should seriously consider the Nikkei 225 futures, considering portfolio diversification and global market conditions.